From a revenue and EBITDA perspective, 2019 was also a record year. We posted a revenue of 7.5 billion for 2019, an increase of 107% year on year. This was supported by the inclusion of Styldrift in the operating results and a stronger pricing environment. The growth in revenue supported a nearly 120% increase in our gross profit to 681 million. EBITDA, which of course excludes depreciation and amortization, increased by nearly 250% last year to around 1.75 billion for this year, or for last year rather. Our EBITDA margin increased from 13.9% to 23.4% in 2019. You'll note that other income increased by 116% to 268 million, assisted by higher royalties from Impala 6 and 20 shaft operations and mark-to-market gains on our forward exchange contracts. I'll unpack the administrative expenses in more detail a bit later, but these increased by an aggregate of 15% year on year to 327 million for 2019. Once-off restructuring cost and scrapping cost increased by 10.6 and 58.9 million respectively. You'll see that the other major below-the-line cost item was a significant increase in finance charges to 430 million rand. The largest component of the finance cost is a 212 million interest charge on the Rustenburg Platinum Mines, or RPM, deferred consideration. This was the interest on the outstanding payment of the purchase of a third of our business from Amplats, the interest rate charged being 2% above our average borrowing cost. We settled the deferred consideration in January this year, which will certainly help to lower our finance costs going forward. Other notable finance charges include the convertible bond interest and interest on our long-term borrowings used to fund the ramp-up of Styldrift. This brought us to a profit before tax of 123.6 million compared to a 316 million profit for 2018. These two numbers are perhaps not directly comparable, as the 2019 profits were assisted by the 2018 profit was assisted by a benefit on a bargain purchase, while the 2019 numbers included the restructuring and scrapping charges that I've noted. Turning now to our headline earnings. On a post-tax attributable basis, our attributable comprehensive income for the year was 64.1 million, or 58.8% lower than 2018. Excluding the once-off items from the 2019 earnings, our headline earnings amounted to 123.1 million, a 147% increase relative to the 2018 numbers on the same basis. On a per-share basis, headline earnings for the year ended at 50.4 cents per share, a 101.6% increase relative to 2018. This is not only a strong increase year on year, but also a significant turnaround from the headline loss of 70.8 cents per share, which we posted for the first half of 2019. This variance analysis highlights the major changes that resulted in the increased headline earnings from 49.8 million in 2018, which I noted, to the 123.1 million in 2019. Elements on the left-hand side, of course my right, highlight the aspects that are within the control of the company, with elements to the right being more outside of our control. The most significant positive increase was the revenue impacts of a 2.5 billion benefit of increased volume. Higher finance costs detracted around 500 million rand, with the increased cost base due to additional volume detracting nearly 1.9 billion from profits. A decrease in admin and corporate charges realised 110 million of cost savings, whilst higher unit costs, which Neil discussed in more detail, resulted in the real cost increase of 687 million rand. On the uncontrollable aspects, positive revenue contribution from a weaker exchange rate added 324 million rand, and higher metal prices added 1.1 billion rand. Higher depreciation and mining inflation detracted 715 million rand and 324 million rand respectively. The benefits of no minorities following the buyout of Amplats added about 100 million to our headline earnings, to bring that headline earnings to 123.1 million for the year. As we've just seen, prices and volumes are the major components that impacted our headline earnings variance for the year. As Steve noted, our basket price per platinum ounce increased 37% to 28,743 rand per PT ounce, assisted by stronger metal prices as well as the weaker rand. The rand remained volatile over the period and averaged 14 rand 55 cents per US dollar for 2019, 5.3% weaker than 2018. The standout performers in our revenue basket was palladium and rhodium. Our average palladium price increased 41% to 1,541 rand an ounce, whilst the rhodium price increased 61% to 3,863 rand an ounce. Our average platinum price for the year recorded a more pedestrian increase of only 4%. We're happy with that as well. Steve earlier gave a brief market update, and it's worth noting that PGM prices today are trading well above the averages received for 2019, with our recent spot revenue basket price now well above 50,000 rand per PT ounce. The diverging price moves within the revenue basket brought about a significant change in the revenue contribution from the various products, with a continued shift away from platinum towards palladium and rhodium, as we've seen last year as well. In 2019, platinum contributed 38% to our revenue, down from 46% in 2018. In contrast, palladium and rhodium, on a combined basis, contributed 47% of our revenue for 2019, up from 36% the previous year. Nickel contributed 7% of our revenue, with gold contributing 3%, of which we've now, of course, committed 70% to the gold stream. Turning to costs. The inclusion of Styldrift was also the main contributor, resulting in an increase of 105% in our cost of sales to 6.8 billion. Neil discussed individual cost pressures at both BRPM and Styldrift in more detail, which of course also added to the higher cost base. The addition of Styldrift is also evident in the change in mix of the cost component, as we experienced increased material cost in the more mechanized environment. Utilities, of which electricity is of course the main component, accounted for 8% of our costs for 2019. The breakdown of our administrative costs are also shown here, with the inclusion of the restructuring cost in this analysis. During the second half of 2019, we initiated a review of corporate costs and a new optimization program. This process, which will continue in 2020, has already delivered a more streamlined business model with improved reporting lines and accountabilities. Our corporate office charges decreased by 24.4% year on year to 187 million rand, with some of the savings of the optimization program already realized in this number. The 10.8 million restructuring costs relate to this program. Our housing cost relates to our ring-fenced housing development, which provides every employee with the opportunity to own a dignified home. The cost increase in 2019 relates mainly to a non-cash swing in the amortization and fair value adjustment of the loans which we offer to our employees at a preferential rate. Massive care and maintenance cost increased year on year due to a full year of ownership. We didn't own it for the full of 2018, with additional once-off cost included to rehabilitate and seal the south shaft and to improve the decline support in the Massive north shaft. Our segmental accounts now reflect a BRPM and Styldrift mining segment, which together make up Royal Bafokeng Resources, which was previously known as the BRPM joint venture. Supported by a strong pricing environment, BRPM reported a 218% increase in gross profit to just over 1 billion rand. Styldrift, in its first year of commercial production, reported a gross loss of 279 million rand due to the high cost and levels of depreciation during ramp-up. As Neil mentioned, we remain confident that Styldrift will continue to see improvement in unit cash cost and profitability as it ramps up to full production. The overall gross profit for the operations thus increased 147% to 807 million rand. On an EBITDA basis, BRPM's profits more than doubled from 776 million to just over 1.6 billion for 2019. Styldrift contributed just short of 300 million of EBITDA in its first year of production and should actually comfortably be able to outperform BRPM at full ramp up. Turning now to cash generation. The growth in our business and improved market conditions contributed to a 54% increase in cash flow from operating activities to just over 1 billion rand. We invested a total of 327 million rand in stay in business and replacement capital to deliver free cash flow before expansionary capital or growth capital of around 700 million. Remember this number. When we talk dividends, it becomes important. Expansionary capital expenditure for the year amounted to 1.4 billion, with net cash flow from investing activities then totaling 1.75 billion, as Neil explained in the CapEx section. Finance activities funded a 655 million inflow, supported by the rights offer proceeds of 1.029 billion. In 2019, we were thus able to fund 68% of our capital expenditure from cash generated, compared to 37% last year. As at the end of the year, for 2019, the RBPlat Group had cash and equivalents of 814 million. The net debt, calculated as interest-bearing borrowings less cash and equivalents, ended the period at 491.3 million, presenting a 41% decrease from 2018. The mining industry, and certainly also the PGM industry, has been particularly guilty of destroying shareholder value through poor capital allocation. We are fortunate that we've been able to build and fund a new world-class mine through the trough of the most recent cycle, and remain committed to be disciplined in our capital allocation, despite the inevitable rush of blood to the head that improved market conditions could bring. Our capital allocation framework is integrated into our strategy, our business planning and management processes, in order to balance risk and returns in the application of financial capital in our business. Critically, the assessment of financial risk and returns is extended also to the consideration of the impact on manufactured, human, intellectual, social and natural capital. Our governance structures, including the delegation of authority, are mandated as such that the right decisions are made at the appropriate level in the organisation to best assess risk and returns, and to ensure that accountability and actions are appropriated at the right level. We apply a rigorous valuation process to motivate, support and track the performance of operational improvements, organic growth projects and potential mergers and acquisitions. This process recognises the significant uncertainty in macroeconomic factors, with the aim to balance risk and return throughout the commodity cycles. The funding of financial capital is a further important component of our capital allocation framework. This is done through an ongoing assessment of the sources of capital, including equity and various sources of debt, in order to maximise shareholder returns whilst maintaining an appropriate level of risk.